Good morning, guys. It is Wednesday, August 14th, 2024. This Bathrobe business. I'm down on my last sip of coffee, but I still have the news. One sec. Okay, let's jump into it. So, big number out today is CPI. So, let's jump into it. I don't think it's as rosy as everybody says, but you know me, I'm an inflation hawk. I think inflation is much higher than it's presented. I have data to back it up. And let's look at the numbers first, and then we'll discuss it. So, CPI numbers rose 0.2% in July, in line with expectations. So, according to this, CPI is up 0.2% for the month, putting the 12-month inflation rate at 2.9%. Now, here's the problem. Even within this article, there's a pretty big flaw in this, and that's that housing is accounting for 90% of this. And housing is actually driving inflation up. It's just all the other stuff that is just going down. So, for example, the cost of bread went down. Where was it? So cereals, bakery items declined 0.5%. Dairy fell 0.2%. Eggs were actually up. But the big number here is increase in shelter costs. They were up 0.4%. So that's responsible for 90% of all item inflation increases. So that's an issue because remember, this number is sticky. Shelter costs are often sticky because once rent is fixed or once housing is fixed, that's the number that stays. So this inflation cost isn't something that can be manipulated as easily with supply chains as something like eggs and bread. Oftentimes, eggs and bread could be the result of a bird flu, of a bad crop season, of a truck flips over on the road. So these items can vary. These items will vary in cost, and they can be based on supply chains, and they can be accounted for, and you can overproduce to bring these costs down. But something like rent, something like mortgages, that's something that becomes fixed because those are numbers that become under contract. Those are your mortgages, those are your lease agreements, et cetera, et cetera. And it's really hard to drive these numbers down. Now, I will share some numbers with you guys. I just realized I'm not sharing my screen, am I? Idiot. Okay. There we go. So now you can see it. I will share a number with you guys in regards to housing. I guess two numbers in regards to housing that do look positive, but I think they look positive from the fact that inflation is steady, but is seeing regression in the areas we want it to see. Right? Obviously, the price of food is going to affect people's lives directly. There's no question with that. But these are variable inflation costs. These are not fixed inflation costs. Whereas something like housing, that's something that is fixed. That's something that becomes permanent for years on end. And I have two numbers that I will share with you that are positive in that direction, but they're positive because we have had high interest rates and we've held those high interest rates. The second we start cutting, we're going to see weakness in those numbers and a resurgence in inflation in those sectors. The other thing I want to share with you guys is this screen. So let me make sure it's sharing. Yes, it is. Gold, my favorite indicator. So gold is up above 2,500. It has hit a new record as of yesterday. So in the 5-day gold numbers, it hit approximately 25.13. Actually, I lie. A couple of days ago, it hit 25.15. This was on Monday. So on Monday, it hit 25.15. That is a new number for gold. That is an all-time high. Now, here's the scary part. During the late 70s, early 80s, when it started coming down, when those inflation numbers started going crazy during the Volcker years and everything like that, gold was at about $800 an ounce. However, if you account for inflation, it was closer to $2,600 an ounce. So the 2,600 has always been a magical number because if we ever hit above 2,600 on the spot price of gold, that would mean we are at record-breaking inflation above anything we have seen in modern history. And remember, if we listen to guys like Larry Summer, he would say we were above those numbers already because he'd say, well, if we measured inflation the way we used to, we would be above the number of what we were seeing in the last 2 years. We wouldn't be seeing 10% inflation. We would be seeing 20% inflation. So 2,600 is the magical number. We are at 2,507. If we hit 26 numbers, we are in uncharted territory. Now, I would argue we're already in our uncharted territory because unlike the late 70s, early 80s, we have something else that they didn't. We have Bitcoin. And Bitcoin is an alternative hedge to inflation. Now, I argue that it's not because, as I've said before, every time the market is up, Bitcoin is up. Every time the market is down, Bitcoin is down. Like when we had that giant stock market crash was it last week, where it plummeted 1,200 points, Bitcoin fell $10,000 as well. And Bitcoin constantly reacts to the market in line with any other asset. So like any other stock, it goes down whenever the stock market is down, whenever there's bad inflation numbers. It stays relatively unchanged. Anytime there's big weakness in the market, there's weakness in Bitcoin. Gold, on the other hand, actually moves against the market. And it's moving against the market right now because the market is saying inflation is low and gold is saying inflation is high. But nonetheless, people do buy Bitcoin as a hedge against inflation. And so if Bitcoin doesn't exist, like it didn't in the 70s and 80s, Bitcoin would be above 2,600. So this is why I keep saying that inflation is actually much higher than what's being reported, simply because the CPI, the PCE numbers, they can be manipulated, and they are manipulated, right? You're taking a basket of assets, and you can pick and choose which assets you include. You take a law of averages and yada, yada, yada. But even in this basket of assets that we talked about, rent is up, housing is up. Now, the other number I want to share with you guys is super core inflation. So this is a month old. So this is from July 11th of this year, obviously. So according to this, super core inflation is actually much higher than CPI and PCE numbers. So even though it's dropping, according to these numbers, super core inflation is at 4.6%. This isn't too surprising because other numbers I've shared with you on this channel put inflation probably near a 4% mark when we've looked at rises in wages, rises in housing, rises in assets. So I would have pegged it at around 3.9% is the number we have talked about here on this channel. But according to this, super core inflation is at 4.6. Granted, this number is a month old, so you can adjust down for that. But the 4% mark seems to be what it's talking about in this article, and I kind of agree with it. Now, this is PCE. This just talks about kind of the same thing. So now let me share with you guys a story about housing. So two stories about housing. The first, actually, let's share with you this one, is that mortgages are actually doing quite well. Mortgage refinances surged 35% in 1 week as interest rates hit the lowest level in over a year. Now, we are seeing this has been for a few months now, that mortgages are below 7%. That they are at 6.5, 6.55. Remember, they hit 6.1 a couple weeks ago. There was that magic number, and then they drifted back up. But this is good because remember, in addition to the prime lending rate that the Fed sets, there is a spread that the banks add, which is the result of insecurity in the market. So there's a complicated formula of how that is tabulated. But overall, when the market seems to be healthy, the spread tends to lower because risk is deemed lower in the markets. So when you're seeing these rates, this is good. We actually probably could get it down to a full 6% with the current prime rate being set where it is. So if we just stay the course, this will happen, especially since we're finally seeing drops in housing costs. Now, I preface this because this is regional. So this isn't necessarily a sign of the times that things are shifting. However, I think this is a step in the right direction for multiple reasons. So Florida has been hit hard, which was hit hard in the 2008 housing bubble, is now seeing prices fall again. And this article is talking about how prices have dropped up to 9%, et cetera, et cetera. Now, this is regional. And Florida also saw some of the greatest surges in housing costs in the last several years. Florida also overbuilt. It is an environment where housing was being built at record paces. We've seen similar trends happen in Texas. So anywhere where a lot of people were flocking very quickly, where prices rose very quickly, and where they overproduced, you're seeing this trend. So I'm not going to say that this is a national trend because it isn't, because in many regions, there is still an undersupply. But the other nice thing about this is one of the reasons we're seeing some of these drops in some of these areas is private equity and smart money, whatever you want to call it, is leaving the environment. So this article is talking just about that, how private equity firms are selling off a lot of their businesses. We've also seen a lot of people divest from their second home, their Airbnbs, etc. So as a lot of the times, rises in these housing costs do come from privatization of the market. It's not necessarily that there's not enough housing to go around, but it's because there's so much little housing to go around after a lot of these big firms come in and buy and rent them out and do, short-term rentals, et cetera, et cetera. It doesn't leave a lot of room for the private buyer. So as these firms are leaving, as Airbnbs are going into the negative, you're going to see more housing costs, more housing availability come to the market. And also, just in generality, when you overproduce, there's going to be more housing coming to the market. So I don't think that this is a major trend. I think it's a minor trend because remember, real estate is regional. However, it's definitely a sign of that we're headed in the right direction. So I think this is a good sign. I think this is why we should stay the course. As you know, I advocate against cutting interest rates. I talk about that all the time. I do not think it's good for the economy. I think it's good for Wall Street. I think it's good for politics, but it's not good for Main Street. And I think there's trends that are showing that we're headed in the right direction, but we need to stay the course. If it was up to me, if I was the federal Fed chair, I would raise interest rates personally, but that's just me. But that's pretty much it. So those are the stories of the day. That's all I wanted to focus on. I got to get to work. So I will see you guys here tomorrow morning. I hope you have a productive Wednesday. See you later.